All right, we are about to start.
So this is a 3:30 section. This one is being recorded. We're gonna start out with a few announcements. Homework 12 is due next Monday. And all the details have been published for that. We understand that people might be traveling for Thanksgiving, so please get your screenshots in and go to office hours if you need to before then. The details regarding the final group project have been announced. You'll be conducting a multiple analysis on 4 companies. So it's the company you chose for group project 3, and you just select 3 peers in addition to your company, and you're doing the analysis on them. Same rules as the other assignments apply. And this is the last chance for somebody to present if a group member hasn't presented in a presentation yet. This Wednesday, there will be no live lecture. However, there is an extra credit opportunity that will be published. We recommend everyone take advantage of this. So you come to the lab for that, as well as homework 12 and the group presentation and the trading challenge on Wednesday. And then we're going to pass around the attendance sheet, so just make sure everybody signs it. I believe there is going to be a class, and I think it's going to be an another extra credit opportunity.
But just wait on Professor
Yeah.
Perfetti to make the final call, both on whether there's class and whether that's going to be extra.
Which is expect there to be class. All right, so we're gonna start off with going over homework 11 that was due this morning. We understand that there was some confusion in this assignment, and people might have used the normal ROIC on the EV to EBIT sheet. However, this is wrong, and you should be using operating ROIC, as it says so on the sheet itself. And you are supposed to be using operating ROIC because it was much higher for all the companies. So moving forward, you must use this for all their assignments. But we're not going to deduct points if you use the regular ROIC on this assignment. And there was also some challenges the lab students were having with Estee Lauder on this with their ROIC. So there were a couple options you guys had that we were recommending. The first was you could build an as-is DCF, but if you didn't have the time to go to the lab or just didn't have the time to go to the screenshots and anything you needed for that, you could also use this formula of the ROIC for the ROIC formula, where ROE times the percent of equity, the weight of equity. So just multiply those and use that instead. And then so moving on to the homework, using P&G as the baseline, Unilever is trading at a discount and Estee is at a premium. We should open up the discussion if anybody wants to explain it as why they think this is the case. If you explain it on your presentation or as you explained it in your write-up.
This one start. Oh, this is starting with this one.
Yeah. So does anybody want to explain why Unilever is trading at a discount and Estee is trading at a premium? Just give it a shot.
Yeah.
I think Unilever drink discount. I'd say primarily because it has higher cost of equity, so it's more implied risk. It spreads, and it has a lower spread in P&G, not significantly, but it does have, but it has a higher growth rate, which would work in its favor. But the higher cost of equity by almost 3% is the main determinant that's causing it to trade at a discount.
Yeah,
by almost 5, or yeah, let's say 5 units. And Estee Lauder is at a slight premium to P&G, primarily because of its significantly higher growth rate of over 3% more. Even though it has its cost of equity, so risk is higher than P&G's and its spread is lower, but the much higher growth rate allows it to trade at a slight premium.
Yeah.
The downwind change, I guess.
Yeah, that's exactly right. So now we're gonna move on. We're gonna move on to the EV to EBIT tab. Here you can see that they're both trading a slight discount to P&G. So if anybody else wants to give their explanation as to why somebody else wants to take a shot at it for EV to EBIT. And
I think we could just run over.
Yeah. So as you can see, the spread for P&G is at 20.59 and Uni is 18.9, and SDA is 7.82. However, SDA has a very high tax rate with the other factors, and G is not high enough to be able to give it the premium because it's not able to overcome that tax rate. And then Unilever is again similar to on the PE tab. It has a very high level of risk, having the highest WACC of 8.6 compared to the 6.8 or 7.8. And then P&G has basically two benefits. They have a very high spread and they have the lowest risk with the lowest WACC. And they also have a lower tax rate than everyone else. And then for the third multiple, EBD sales, Unilever trades at a discount, and so does Estee. So does anybody want to give their explanation for that one? And for that, you're using top there, the margins and productivity. Okay, so P&G does have the worst productivity, but they also have the highest margins by far. They have much higher operating margin and no PAT margin, which explains why they're trading at a premium to the other two. And then for Estee, they have the best productivity, but a lot significantly worse margins, which would explain why they're trading at the lowest multiple there. And that's
All right, so quick thing about this past homework assignment is that some people might have had slightly different numbers based on when you took your screenshots and what data you had. So as long as your numbers match your screenshots, and you are able to explain the reason why something was trading as a premium versus a discount, your assignment should be fine. But once again, as a reminder, operating ROIC is what we're expecting, not the regular ROIC, but we're not taking off points for people that use regular ROIC because we know that that wasn't clearly mentioned in the recording. Does anyone have any questions about this past homework before we move on?
Homework for next Monday is just like same format.
Kind of. So it's pretty much kind of the same thing, but the next homework is probably going to be dealing with companies that have messier like metrics and data. So this is what we're going to spend the rest of the lecture on in terms of how you deal with companies that have maybe missing values or values that are just completely irrational to the work of this model. And so how do you convert those values to get a sensible model and sensible output out of the model?
Could you clarify the ROIC things? You're saying that we're talking about the UV, we have to use the expected rate of ROIC.
Yeah. So a lot of people were just using like from the RV screen, just the regular spread ROIC, not like the operating ROIC. And that was giving a lot of people like negative terminal growth rates. So
Any other questions about the past homework? All right, so for the next portion of the class, we're going to start by having you guys kind of conduct the same analysis or try to for 3 other companies. They're going to be Lockheed Martin, which has a symbol of LMT, RTX, which has a symbol of RTX, and Boeing with a symbol of BA. This is going to be an example of companies that have messy values and how you're going to deal with that. And then as you approach those, if you have like values that you think work out for this model or you filled it out, you can come and show it to us. But in the rest of the class, we're going to go over how you deal with those values and the ideas that are available to working around having messy data in terms of multiples and the metrics for this model. So that's going to be the next portion of this class for like the next 15-20 minutes. And once again, the companies are Lockheed Martin, RTX, and Boeing.
and you can work with a few other people around you on this one as well.
Yeah.
Yeah. Boeing.
So it's been about like 15, 60 minutes. Did you guys get a chance to look at some of the numbers and kind of get an idea what we meant by like messy data and how the values look all over the place? All right, so we're gonna kind of go over one, like the example that we had gotten for going over companies that have missing data. So. I'll go over, it's the one with the screen. So here is like an example of how we approached it. And so it kind of involves doing a lot of convergence and going kind of all over the place, but it kind of forces you to do that because if you look at some of the data that you get, it doesn't look reasonable. For example, we have a screenshot of Boeing ZEO here. And so if you look at the forward year two PE ratio, you'll see that it's like 572. That doesn't really make sense in the real term world when you're comparing to Lockheed Martin, RTX, who are like relative competitors, and they have a EPE ratio in the 18 to 20 value range. So it doesn't make sense to use a PE ratio of 572. So in this scenario, what we kind of did was you just pushed another year out. So we used the forward year three values. So in this case, because our last reported year was like 2023, our forward year three value would be 2026. And so we use the values from 2026 to kind of start building this multiples model. And so you see our PE ratio is around 29.38. And then on the other sheets, you'll see that our EV to revenue and EV to EBIT are the $1.57 and 23 cents. You can also see that our ROE in this case is kind of messed up as well. It starts at like 87% and it goes up to 1,272%. So it doesn't really make sense to use the ROE values that you see here because it doesn't make like it's hard to say that you're making 1,000% on your equity as a return. Similarly for Lockheed Martin, you probably saw that their ROE was a bit messed up, that they had like an 85% ROE or an 81% ROE in the current year. And then that one kind of, it's relatively stable going between like mid to high 70s and then low 81%. So it kind of stays stable in terms of its own range, but it's still very high in terms of using that as a value in their multiples analysis. So one of the conversions that we did was we used ROIC as a reference point for ROE. Now, you might have noticed that for Boeing, you couldn't have gotten an ROIC. It wasn't showing up. So what we had to do eventually was we had to pull up a DCF for Boeing. We did an as-is DCF, and we used the ROIC value from that to kind of use it as a proxy for our ROE in the model, as well as using it as the ROIC in our EV to EBIT model as well. So that's kind of one of the ways you can go about this. So if you have a relatively good EBIT, good ROE, you can use that to find your ROIC. If you have a relatively reasonable ROIC, you can use that to find your ROE. And the process between those remains similar. So if you want to go from ROIC to ROE, like you're solving for ROE, you just divide your operating ROIC by the weight of equity. In this scenario, I think the weight of equity for Lockheed Martin was like 0.877, so 87.7%. So you just divide that by 87.7% and you get an approximation of ROE. And similarly for Boeing. Now, because Lockheed Martin's ROE was relatively stable in terms of its range, being that it's in the high 80s, you can have a bit more flexibility with how far that range goes. But when it's a smaller value, as in like 4 or 5, and then goes up to 9, that's almost doubling as a ROE. So that's no longer considered stable. But a plus or minus 5% when you have an ROE that's 80% on Bloomberg is not much of a change. So it's kind of stable. You can infer that kind of your operating ROIC in the present is a relative inclination of how it's going to stay in the future, considering that ROE tends to be plus or minus 5% in its own terms on Bloomberg. And so we used Lockheed Martin's operating ROIC to find their ROE. We got the ROIC for Boeing by doing an as-is DCF, and we used it on the other sheet, and we also used it to find Boeing's ROE. And so that's kind of the process of when you're working with messy data or data that's all over the place, how you kind of navigate that scenario. We started with Boeing, we used forward year 3 values because the forward year 2 values didn't make a lot of sense. And then we kind of had to build an as-is DCF to get the ROIC. And from that, we were able to get the ROE as well. And so that's kind of how you find a way to get the values that are not seemingly clear when you're looking on Bloomberg. This is kind of what's going to be, you're going to be working on like homework 12, where you're going to be assigned companies that are likely going to have some form of messy data. And you're going to have to figure out your way through how can I get the data for this, get relevant or realistic numbers for this model to make sense, and what are the ways I have to do so. And so in this scenario, you can kind of see that after we solve for it, we can compare RTX to Lockheed Martin. RTX has a spread of about 6.2% compared to Lockheed Martin's spread of about almost 28%. And so it's obvious that Lockheed Martin has a bigger spread. However, what helps RTX to get a premium is that they have a 3.37% long growth in net income as compared to Lockheed Martin's 1.44%. And so that's what's allowing that increase in growth. The increased growth in net income is what's allowing RTX to be a premium and have a higher multiple than that of Lockheed Martin. As for Boeing, Boeing has a anticipated spread of about 21%, and they have a growth of net income of about 7%. And so because they have both, well, they don't have a higher spread. They have a lower spread, but they have a way higher growth. And so despite having a lower spread, their higher growth allows them to be a premium when compared to both Lockheed Martin and RTX. And so that's kind of a scenario where you're kind of guesstimating, making an educated guess about what some of these metrics are when you don't have them directly available, and how you can kind of make the most out of the data that you currently have on hand. As to the next sheet, you'll see that we also did a form of approximation here as well, starting with RTX's ROIC. If you look at RTX's return on equity, and this is where I kind of talk about when you have a smaller return on equity, a smaller change is still a large change. When we were talking about Lockheed Martin, the current return on equity for the current year, or the actual year, it was around 81. Now, when you go from 81 to 77, that's only a minus 4% change, which could seem a lot, but you're starting at 81%. So it's not much in terms of what the original number was. However, in RTX's case, ROE started at 4.825%, and then it went up to around 13%, and it stayed relatively flat around 13 to between 12 and 14%. And so for that reason, we decided that because ROE is shifting so much in terms of doubling, nearly tripling of its current value, that means ROIC that's current is probably not a correct approximation of what our forward ROIC is going to be. And so we used the inverse of the conversion method that we talked about on the first sheet, and we basically did ROE times the weight of equity. So that's how we got our ROIC value here. And that's kind of the similar, going back into the connection between ROIC and ROE. They're not directly connected like this. This is still an approximation, but it gives you a educated guess of what ROIC or what ROA could actually be. Having that said, the ROIC for Lockheed Martin, once again, because their ROE still seemed a bit stable in terms of them having a high ROE, but it was still a bit stable. So we use the ROIC value that represents the current timelines, because we know ROE is going to be stable. So therefore ROE is going to still kind of be stable. And so we used 29.95%, which is their operating ROIC currently. And for Boeing, we use 18.87%. And once again, we got that by doing an as-is DCF. Now, when you don't know the exact, so this is going back to Boeing specifically, when you don't have the ROIC value at all, and your ROE is not a good estimate because it fluctuates a lot, there's two ways about how you can get your ROIC. You could do an as-is DCF, get your ROIC, and then that's your ROIC, and then you go about the rest of the model estimating ROE. Or you can do a DCF and get the terminal growth rate, put that into the multiples model, and then goal seek ROIC. In this scenario, both kind of values get a similar outcome because our growth rate in the as-is DCF was like 6.88%. And as you see here, it's around 6.24%. So we can say that the as-is ROIC that we got is pretty in line with what the multiples model would show if we use growth rate as an estimate for ROIC. And so there's two kind of ways to go about it. You can input ROIC by doing the as-is, or you can input G from the as-is and then solve for ROIC. But usually, if you do the process correctly, you should get somewhat of a similar response or similar outcome in both scenarios. So in terms of EV to EBIT, we can see that both RTX and Boeing are trading at a premium in comparison to Lockheed Martin. In terms of RTX, we can see that they have a much lower spread and a higher tax rate in comparison to Lockheed Martin. Their spread is about around 4%, and Lockheed Martin's spread is about 23%. Their tax rate is about 4% higher than Lockheed Martin's tax rate. And the main driver as to why RTX is trading at a premium in terms of EV to EBIT is because of their higher terminal growth rate. In terms of Boeing, they have a spread of about 10%, which is much less than Lockheed Martin's spread of 23%. They have a close tax rate at 16.2 in comparison to Lockheed Martin's 15.5. The reason why they are trading at a significant premium in terms of EV to EBIT is primarily due to their 6.24% growth rate. And that's what's allowing them to, it's much higher than Lockheed Martin's 1.26. And that's what's allowing them to grow at a much higher rate and have a much larger EV to EBIT multiple. In terms of EV to sales, you can see that RTX is trading as a premium and Boeing is trading as a discount in terms of Lockheed Martin. And so EV to sales is kind of based on the three factors you see above: operating margin, NOPAT margin, and your productivity. The reason why RTX is trading at a premium to Lockheed Martin EV to sales is because they have a slightly higher operating and NOPAT margin. The productivity, which is higher, is worse for RTX in terms of being compared to Lockheed Martin, but there are slightly higher margins and operating margins and NOPAT margins help push their multiple of EV to sales to a premium level when compared to Lockheed Martin. As for Boeing, they have the best productivity out of all three companies at 29 cents per dollar of sales. However, their very low margins is what caused them to trade at a discount to both RTX and Lockheed Martin in terms of EV to sales. And so this is kind of a scenario where you guys are dealing with messy data that you sometimes makes no sense in terms of like ROE or ROIC, or you just don't have data at all, and how you can kind of maneuver through that difficult situation to get a reasonable model or reasonable output in the multiples analysis. You can see that there are like slightly relationships, a few relationships between some of the approaches that we've been doing so far in the class between, getting values from your DCF to put them into your multiples analysis and so on and so forth. So realistically, you want to see similar outcomes between what the values you're getting out of your multiples analysis and what you're getting out of your DCF. They don't have to be exactly the same, but they should be relatively close. And that should help you in understanding that what you have going on in your DCF or multiple analysis is reasonable and is in line with what the overall market's thinking, especially when you're getting data from Bloomberg and so on. And so this is kind of like an example of how you would go about doing the multiples analysis for companies that just don't have the most reasonable data that you would like to have. Does anybody have any questions about the stuff I spoke about?
To find operating ROIC, you can multiply the ROE by weighted equity, or you can do that as is.
Yeah, so when your ROE is stable, well, sorry, when your ROE is stable, especially like in the future, you can take an approximation of where ROE is going to be and use that as a proxy for ROIC by multiplying it by the weight of equity. We're gonna have a file that we're gonna post as well that allows you to go from ROIC to ROE, and vice versa as well. So if you guys want to make the process easier for you. As for when ROE is kind of not super stable and you want a more realistic value of what ROIC will be, the as is DCF is an option, but it is more difficult. So we kind of say try the option of going from ROE to ROIC first because it is easier. However, in terms of what's the more accurate value, the as is DCF is probably more accurate.
Right now.
Yeah.
Where is weighted equity on? Where we find that?
The wax.
Wax screen. The wax screenshot has the weight and cost of equity on.
I'm assuming a negative ROE isn't good for the first part.
Mm.
On Starbucks and McDonald's CEO screens, they have like super negative ROEs.
Yeah, so that when you have like messed up ROE values, you have to kind of go from ROIC to ROE. And the way you do that is you just divide ROIC by the weight of equity
Or the
or the as is model. But if in those scenarios where ROE is kind of like unclear or messy, I would push you towards doing an as is DCF because you want to have an accurate value for perpetuity ROIC.
So just to confirm, like a really negative number is considered messy.
Yes.
Okay.
We did a similar assignment in the past when we were taking the course where we had McDonald's and they had ROE values that were all over the place going from -100 to 250. And so in that case, you kind of have to start with ROIC and move your way towards ROE to get an approximation of both values.
New PE model, we use fiscal year 2026 as your price to EPS. Do you have to then use like all other numbers from 2026 or do you go back to 2025?
So yeah, so I think that was a slight mishap on our part. I see what you're saying. But in terms of the values for 2026, the only value that we did not change was our expected net income for 2026. We had that from the 2025 value. But in terms of your multiple, the actual, yeah, so we should have changed this, which obviously does change the scenario. However, it shouldn't change it by that much. For example, I could change it right now and then resolve it for you guys. So yeah, usually you should pull all the numbers from the same year. So this was a mess up on our part. We used the 2025 net income, so 2026. But usually if you're using one year, a specific year, you pull all the same values from that year. For the company that's at hand. For example, we did it for Boeing to estimate a perpetuity PE. And so that's why we used forward year 3 instead of forward year 2, because forward year 2 was messed up. But you don't have to apply that same, if you do it for one, you have to do it for all 3. No,
But like not all the values that you get from like 125.
No, so for Boeing, because we picked the PE from 2026, the rest of our values should be from 2026 as well, except for like WACC, that's your current WACC. But your expected ROE does not have to be from 2026. That's based on what you think ROE is going to be in the future. Net income should be from 2026. Does that make sense?
Like from each year, do they like each company, do they have to be from like every single one 2020 or the
No, so you can see on the bottoms, there's like the Lockheed Martin RTX, we did 2 years out. And then the last one we did 3 years out,
Okay,
but
so
the, it doesn't have to always be the same for each company.
Okay.
But for each specific company, they should be all from the same year.
The American supposed to be the adjusted or like, yeah.
The gap.
Is it?
Yeah.
There's some video I used to-
Can you use the adjusted? Okay, so
Should be 9.
So the net income should be adjusted as well. Okay. We can double check that with Professor Pavati, but I think if he covered that in the video, then it probably should be adjusted. Sure. Wait, let me just pull it up real quick. Right, this is one of the, it's, okay. Yeah.
Yeah.
All right, so this is like the homework help file that we were talking about. And this kind of helps with the conversion from starting from ROIC going to ROE. This was from last semester that we were given when we had to do McDonald's that had a messed up ROE. So we used ROIC as a proxy for ROE and kind of made the process pretty simple as to how to go about doing so. So if once we upload it, we're gonna have another sheet for going from ROE to ROIC as well. So you can use it for either or scenario. And basically what you would start by doing is just inputting the, whether you're starting from ROIC or ROE, you would input those values at the very top. So where it says expected operating ROIC, if you're going from ROIC to ROE, you would put your ROIC values up there. And then you would put your weights of debt and weights of equity in the yellow boxes below. And so that will automatically calculate an approximation for ROE for you. And we'll have another sheet that's basically kind of a similar process, but you're starting with ROE and moving your way down to ROIC. And so that way it takes the manual error of doing math on your part out of the process, and you can kind of just use the file to just input data and get an output out.
So just to be clear, for even if you did set up an expected operating ROIC, we can just use the template that you made for that. And then like we would have to face on negative values to some.
Could you explain what you had?
So like we have a template already, like the operating ROIC.
Mhm.
And then we would just put that to then like for example, Starbucks has a negative ROE.
Mhm.
We can take the operating ROIC and find an ROE.
Yeah, so that's the purpose of what this is. It's basically a play on the equation that Professor Perfetti had up here, where it's like you start with ROIC, multiply it by the leverage ratio to get ROE. And so basically it's just a dedicated file just for you to just input values that you already have and then figure out the approximate ROIC or ROE value in comparison to what you were starting with. And so it takes the process of doing the math on your own out of it, so you don't end up having to deal with like making a manual error and that's causing the problem. And so it just becomes a simpler process. Well, if you don't want to do it that way, you can also just do it the way we said of multiplying or dividing by the weight of equity based on the value that you're trying to solve for. But the other file that we're going to post shortly is going to be just the tool that to kind of help you guys out. Does anyone else have any questions?
You can talk about the operating
I don't think so. So if the assignment mentions that you need screenshots, usually you would then need to have screenshots, but if the assignment doesn't mention it, then
You
just see the
9 it says in there.
Yeah.
It says in the description.
How we got the operating ROIC then, like.
In your write-up, yeah.
As in the write-up.
Or in the presentation, we make it very clear where you got everything from.
If you do DCF, say.
Yeah.
Yeah, and it doesn't hurt. I don't think the DCFs are required of the submission,
But
but it doesn't hurt to just upload it.
for a presentation, it'd be something to go over too.
Yeah. All right, so if nobody has any other questions, that's pretty much the end of today's quote unquote lecture. If you guys have any questions, we're probably gonna be up here, but with that, you guys can use the rest of the time to work on homework 12 or kind of just work with your groups on the group project in terms of deciding what peers you want to choose for the group project for. All right,
Things like that Wednesday.